this may not be as crazy as we think. So give us some kind of historical context as to how, kind of different is right now versus the past times of the stock market.
So like most investors, the best thing you can do as a young person is to lose all your money. And so I did that many times early in my career, discretionary trading. And that's what moved me more and more towards quant, by the way. And so, run an asset management business now. But the foundation for this was I said, look, I have all the behavioral biases. I'm overconfident. I'll take too much risk that you give me. So I really need to understand and have some expectations to which to set an anchor to ground myself. So to be an investor, you essentially have to be a student of history. And so my favorite investing book, Triumph the Optimist, you can go back over 100 years, investment returns. Really, you can go back to Amsterdam Stock Exchange in 1600, but really in the modern era, there's about 200 years. But if you look at today and what's going on, this feels weird to say to a lot of people, particularly younger people, but this all is pretty normal. And the reason being is that normal stock market returns are extreme. And let me elaborate on that. We wrote a paper a number of years ago called Where the Black Swans Hide. And it demonstrated that down 5% days are totally normal, as are up 5% days, right? This is the tails of the distribution. They happen about 1% of the time. Even down 10% days, totally normal. They happen about 0.1% of the time, and this is in all the countries around the world. And then even bigger down days can happen, of course, and in October 87, we had down 20, and plenty of markets around the world. I think today, some are down 15, 20% alone. But the funny thing is people don't expect that. So as you came into this year, for example, all the Wall Street strategists, I did this in a tweet, they said, what do you expect stock returns for next year? And they clustered in between -3 and 10%. But if you look at the historical yearly returns, it's like 80% of the returns fall out of that range. Yes, that's the average, but normal returns are extreme. Look, last year we were up 30, right? This year down 30 or wherever we are today. But that's pretty normal. Now, that having been said, you traditionally see volatility cluster, meaning, as you've seen in the last month, these huge up and down days. And we did this study and we showed that most of these big down and up days occur after the market is already declining. So you could use something like the 200-day moving average and say, why though? It's like around 2/3 or 70% of these big up and down days occur when the market's declining. Well, if you think about it, and it makes a lot of sense today, it's because people are emotional, right? Markets are going down. They use a different part of their brain when they're making money. I think back to last year, people probably checking their account balance every day on Robinhood. They're thinking about buying a new house. They're patting themselves on the back for how smart they were. And look at that stock I bought. They're bragging to their neighbor. They're opening their account statements, all that stuff, right? And the very real, visceral, physical experience of making money, it stimulates a lot of the same parts of the brain as many pharmaceuticals would or drugs would. On the flip side, when you're losing money, it's a very real, visceral, physical experience. It's painful. You don't want to open your account balance. You don't want to talk to your neighbor. You say, that guy's such an idiot for recommending that security to me. I can't believe I listened to his advice. It's so stupid. And at some point you start to panic and say, I can't take it anymore. I got to get out. Look, we're only down on the stock market, I don't know, let's call it today 30%. And had you not studied history, you wouldn't have realized that, look, we had two 50%ers in the last decade, back to 2000. But you go back far enough, you remember the Great Depression, that was over 80. And in plenty of stock markets around the world, you've had worse. And in a couple of stock markets, Russia in 1917 and China in 1949, they said, nope, thank you very much. We're closing it. The government's taking all of your assets, no more private businesses. And that's had to do with communism. But you had to know at least what was possible. We did a tweet last night where, and this goes along with another article we did on expectations. And we said, by the way, this is a fact, so interpret it as you want. But long bonds, one of the most universal beliefs in the entire world of investing is that stocks outperform bonds. 99% probably of people believe that as a fundamental truth. But the problem is most people don't believe that stocks can go long periods of underperforming bonds. And right now, as of today, stocks have gone 40 years underperforming bonds. Had you studied history, you would have known that. You would have known there's been periods of 20 years, a couple of times. In the 19th century, you say that's too long ago, there's a period of 68 years. So the challenge with that is most people think in terms of days, hours, weeks, quarters, and certainly not years. And that mismatch of truly setting expectations and what works on a long period and actually implementing it causes a lot of problems. And as your partner said, I said this on Twitter the other day, Mark Yusko, one of my favorite quotes is, investing is the only business when things go on sale, everyone runs out of the store. And that's the beauty of the quant approach and having a plan. And we can talk more about that. But if you don't and let the emotions work their way in, that's where you start to see fractures and problems happen.
Yeah, it's so funny. One of the first things he ever said to me is humans are really good at doing two things. One is they always buy what they should have bought, and they always sell what they're about to need, right? Which is kind of the same thing around when the prices go down, everyone runs away. But I think that the book that you mentioned kind of about this optimism, right? Essentially what you're saying here is if you believe that it's not going to go to zero, right? These dips and kind of drops in the prices are actually opportunities, right? And again, as long as it doesn't go to zero, they end up having high volatility days or over long periods of time. You get kind of a continued increase in value across the different stock markets. But that's the difference between being emotional today versus some long period of time, actually having a plan, being disciplined, kind of in control of my emotions, et cetera.
Let me give you a good example from the book. And so it looks at like 30, 40 different stock markets back to 1900. And there's so much information, but it gives you a great base case. So if you look back historically, stocks have done around, let's call it 9% a year. And then after inflation, down around 5% globally. Okay. So if you call inflation 4% during that period, bonds historically did around 6%, after inflation 2%. Bills around 5%, after inflation 1%. So I call it the 5-2-1 rule. So after inflation, your expectations would be that stocks return 5%, bonds return 2%, bills perform 1%. One of the key parts about this study is that it's really important to diversify. Because again, you go back to 1899, we're sipping champagne, we're having this discussion in London or New York or wherever it may be. It wasn't altogether clear that the U.S. was going to dominate the 20th century. You had a scenario where then in 1900, by the way, the vast majority of the U.S. stock market was railroads. Okay, but also the U.S. wasn't the largest market cap country. UK was. U.S. was only about 15%. They ended the decade around half, the century around half. So massive outlier on the upside. Now they weren't the best performing stock market. I think tiny South Africa was. But there were other ones, ignoring the ones that were zero, that had essentially zero return, Austria and others. And if you flip the equation and look at the bonds, same thing. Some bond markets did great. Some went to zero, usually because of hyperinflation, world wars, et cetera. But the beauty of this is, if you take a long view, and we wrote a book about this called Global Asset Allocation. And we said, look, there's all sorts of investors out there, super famous investors, like Dave Swinson from Yale, Rob Arnott from Research Affiliates, Warren Buffett, Mohammed El-Arian, that all at some point have said, here's a recommended asset allocation, okay? And in this book, we said, okay, let's see, as a quant, let's see how these have done in history. And so we took all the main ingredients. So if you're taking all the ingredients off the shelf, you got global stocks, global bonds, global real assets like real estate and commodities, gold. And we said, let's look and see how these portfolios performed. And we took them back all to 1972. We're going to take this back to the 1920s. We've already done it, but hopefully update that this year. And there's some interesting takeaways. First of all, is that all the portfolios did great, but they were hugely different. So some portfolios said you should have nothing in gold. Others said 25%. Some said 90% in stocks. Some said 25%. So there's these massive differences, right? But in reality, it turned out it didn't matter all that much. And let me give you a good example. So if you go back to 1972, and I said, Pomp, I'm going to give you a crystal ball. I'm going to let you pick the single best performing asset allocation model from this book. And I'm going to let you implement it from 1972 to 2018, 2019, 2020, whatever. How how much would someone pay for that? In the billions, probably PIMCO, any of these, Fidelity, Schwab would pay billions of dollars to have this perfect foresight into what works the best. And I said, however, you have to implement this with the average mutual fund fee of today, which is 1.25%. Forget going back to 1972. Index funds didn't really exist, but the average mutual fund then. And you say, okay, well, walking forward, if you look at the best performing asset allocation, implementing it with perfect foresight, but with those fees, transforms the best performing asset allocation to almost as bad as the worst, rendering the entire asset allocation decision almost meaningless. So if you're doing the just basics, what I like to call asset allocation for dummies, your specifics don't matter that much as long as you have some global stocks, some global bonds, and some global real assets. And I liken this to baking. You know, my mom's from North Carolina. She doesn't ever use cookbooks. She does it by feel, this much butter, this much sugar. If you exclude whole categories of ingredients, it's probably not going to work. So you put all your money in gold, probably not going to work. But in general, if you have the main ingredients, it works out just fine. And so people obsess so much about, gosh, do I have too much in bonds? Should I have too much in stocks? What do I do this with this? And in general, as long as you have the basics covered, it doesn't really matter. As long as you don't implement it very foolishly. And most important, do the really dumb thing, which is make really dumb behavioral mistakes. And panic at the bottom, sell at the top over and over. We see so many examples of this. Today, we'll get updates. They do this every week. My favorite example of rationality is the American Association of Individual Investors. They do a weekly survey, goes back to the 80s. They say, are you bullish, neutral, or bearish on the stock market? And the most bullish reading ever was in December of 1999. The single worst time to be bullish in the history of our lifetimes. And the most bearish people was in March of 2009. Again, you cannot make this up. This is not some academic, hypothetical. This is the real world. And today it's probably going to print something really low. We'll see. But historically, if you sort based on those extreme readings, it's usually a really good time. So that sets the case for the expectations of the base case. And why is that important? Because we did this piece recently online, a 4-part series recently about what's going on in the world. It was like Time to Panic. And then it was a 3-part series called the Get Rich Portfolio, Stay Rich Portfolio, How I Invest My Money, and Investing in the Time of Corona. And the first part about the Get Rich Portfolio was that if you put money to work, I hope there's 20-year-olds listening to this podcast, because this is fantastic opportunity. You put money to work right now, you get 10% returns, just for math's sake. 25 years, you 10x your money. 50 years, you 100x your money. You do not have to do anything. It takes zero effort. And we talk so much about this on the podcast and the blog. This is the beauty of capitalism and free markets, is you can take a little bit of the sweat of your labor, put it into other people's labor, and magically transform that into multiples of money in future decades. So the decision by far that swamps everything else is when you decide to start investing, how much you save and how much you invest. And so the basics, again, we can talk more about a lot more timely and tactical implementations and tilts and everything else, but this is something anyone on the planet can do, and do it for no cost essentially today and have phenomenal returns. The hard part, of course, is avoiding those emotions which try to lead us astray.